Assalamu alaikum.
Sorry for the delay. I had to pray. All right, so I think we can we can begin, inshallah. All right, let me share my screen. Can you see my screen?
Yes.
All right. Okay, so to begin with, so today what we'll be covering is bad debt expense, right? So I thought we'll just go through what bad debt expense is, explain it a bit, inshallah, and then we'll do a question in order to make things as clear as possible, inshallah. All right, to begin with, what is bad debt expense? So bad debt expense is when a company sells on credit, they make sales of their product on credit to customers, and then after a period of time, the customer is not able to pay the amount that they owe the company, right? So when the company when they're not able to pay this amount, or they refuse to pay this amount, the company is losing out on money that is owed to them, and this is called bad debt expenses, right? So there are multiple ways. There are two ways of dealing with bad debt expenses, right? So the first method is called the direct write-off method, and this is not really relevant because it's not usually used by most companies. So what is done here is that the amount like now let's say we have 100,000 of account receivable, right? And 20,000 of that the company is known as bad debt, that it's not going to be paid. So what the company does is they just debit an expense account called bad debt, and they credit accounts receivable. The issue with this method is that on the balance sheet, which is a statement of financial position, the account receivable just reduces. You see, there is no it is not clearly shown on the statement of financial position what happened. It just reduces. The only area where the bad debt expense is clearly shown is on the statement of for the profit and loss. And this is not a satisfactory way of dealing with bad debt expense, and it is it goes against the matching accounting principle. It needs to be like things need to be shown on both the profit and loss statement as well as the balance sheet, the state of financial position. So the method that is generally used is the allowance method, and this is what we'll be doing our example with today. And we will be I'll be explaining it, and then we'll do our example according to this method, right? The only thing I'm pretty sure, I think that your professor also would have explained the allowance method to you, and not the first, because that's really not used. But if they ask you a question why direct write-off method is not used, you can explain that because the effect of the bad debt is shown only on the profit and loss statement and not on the balance sheet. So we need something to we need the occurrence of the bad debt to be explained on both the financial position statement and the profit and loss statement. Okay, so moving on to the allowance method itself. So for the allowance method, what happens is we create a contra account. So we create another account to where we show what's happened. So when there is a bad debt, when the company wants to record a bad debt, right? Or when the company wants to record an allowance for bad debt, because very often the company, from past experience, let's say they in the last few years, 3% of their sales of their account receivables was not paid by the customers. So they will understand that, okay, this is a amount that generally each year we don't get this percentage of our sales. So at the beginning of the year, they could they can set an amount for the allowance. They can set an amount that is called an allowance for doubtful accounts. And so if any money is not paid, then this allowance is simply reduced. You get it? So this is the way to it's safety measure essentially speaking. So now to move back to my earlier example, let's say there was a company that had 100,000 of credit sales and 20,000 of it was going to be written as bad debt expense. So the first entry, the first journal entry that is required is that you would debit the bad debt expense account, right? And you would credit the allowance for doubtful accounts, right? And then this if this is at the beginning when the collection of the bad debt is regarded as doubtful. When the company eventually decides to you know to write it off and to say that okay, this is uncollectible and it is not collectible anymore, then they debit the doubtful account. They debit the allowance for doubtful accounts account, and they credit the accounts receivable. Now finally they have credited the accounts receivable. So the account receivable, whatever amount it was 100,000, they will reduce it by 20,000 and they will debit the allowance for doubtful accounts. This will become clearer when we do our example, but this is just a run through of what it is all about, right? Second, and then moving on, so that is the way you deal with the bad debt itself. Once you have a value, once you know, okay, this much bad debt is there for the company in this year, then we deal with it by using the allowance for doubtful account, and we have those two entries. But then moving a step back, we want to know how you estimate the bad debt expense. So there are two ways of doing it. Usually the question that you are solving will tell you exactly how to estimate the bad debt expense. So the first method is the accounts receivable aging method, right? So so if you look at this table over here, right? Let's say this is a company, let's say this is a customer that owes you money, right? So according to the company, which is us here in the question, this customer for the last 30 days, right? For the last 30 days, this customer owes us in the last 30 days, this customer owes us $10,000, right? And 1% of it has not been collected, right? And in the last, and between the last 30 to 60 days, there are 2,000 total receivables. 4% of it has not been collected. In the last 61 to 90 days, you have 5,000 receivables. 10% hasn't been. So you can see that as time goes by, the percentage of non-collected amount increases, which shows that companies, when they're making an allowance system, right? So typically speaking, if there's a customer who has not paid you a certain amount, has not paid you amount in the last 20-30 days, then we give it a small allowance. So here they have given allowance of 1%, right? They have given it an allowance of 1%. Now, if this customer has gone between 30 to 60 days without paying an amount, without paying what is owed to the company, then there is an increase of allowance. So now they have said that, okay, from the 2,000 owed between 30 to 60 days, it has been more than 30 days since he has not paid. So we will estimate that 4% of what he owes to us, he will not pay. And then it increases as time goes by. So if you look at over here, for this customer, it has been 91 plus days since he has not paid the owed amount. So the company estimates that he will not pay at least 30% of it. So this is one method of estimating what amount your customer will not pay you. The longer they have not paid you what they owe, the greater the possibility of the bad debt expense, and the higher the allowance to make. All right. So this is basically one way of estimating the bad debt. And in the question, of course, they will explain to you exactly how they expect you to estimate the bad debt. And this is one possible way, right? The other way is just it's much more simple, and this is usually more common, I think. And this is the percentage of sales method. So let's say the company, they will tell you the company has made sales of 2 million in the year, and the company estimates that 2% of this sale will be uncollectible. That this will be their bad debt expense. So then it's a matter of simply putting 2% multiplied by 2 million and then you get, okay, what percentage of the sales you will get, okay, what your bad debt expenses, and then you have to deal with it, either then you have to deal with it in the methods that I explained above, right? So this is all very very theoretical, uh, very theoretical, and now we can move on to the question. We can try to solve a question, and then inshallah, if there are any doubts that you have, you can clarify that. Inshallah. All right. So oops. Okay, so this was a good question that I thought we can cover. All right. Uh, okay. All right. So this question is Moni. So as of now, you guys all you were following what I was saying, right? Is there any question that you have before we begin before we start the tutorial question? Anything that you'd like? All right. Okay. So let's begin. Murni Farhad. Okay. So in this question. So we'll read the question. So the extract of the unadjusted trial balance of Murni Barhad as at December 31st, 2016 is presented below. So one key key phrase to remember here is that this is the unadjusted trial balance. So obviously that would mean that they will tell us that there are things that need to be adjusted, and so we need to make those changes, right? And this is what they have given us: net sales 312,800 ringgit, accounts receivables 45,000, 6% short-term note receivables 10,000, and allowance for doubtful accounts 2,600. This is what they have given us already, and now we need to work on it, right? Okay, so if you look at what's required here, they ask us show the journal entries to record the above transactions and update the relevant accounts affected. Then prepare the extract of the statement of financial position as at 31st December 2016, showing the assets section only. So when they ask you this, I mean, of course, you should not try to do more work than necessary. You just show exactly what they asked for. They've asked to, in this, we will only be showing the SOFP, the asset section of the SOFP only. And thirdly, explain why direct write-off method for uncollectible accounts is not acceptable for financial reporting purposes. This is something that I explained already, but inshallah, when we come to this, we'll just briefly, maybe I write something so you can, so it'll be clear. Okay. Okay. So for this question, for part A, we have sales on credit to a customer on 31st December 2016 amounting to 12,500 have not been updated in the company accounts. Okay. All right. Okay. So can anyone see what should be the double entry here for part A? Sales on credit to a customer on 31st December 2016 amounting to 12,500 have not been updated in the company account. What should be the double entry for this transaction for part A? Can anyone answer?
Debit account receivable.
Okay. Debit accounts receivable. Okay. 12,500. And then what do you credit?
ADD, allowance for doubtful debt.
Credit sales.
Yeah. No. Yeah. You credit you credit sales revenue, or basically net. You can credit net sales from what you have. So let's make it sales revenue, because this is basically, they have just told us that there was a transaction that happened during the year, and the company has not recorded it. It was a credit. It was a credit sale. So when there's a credit sale, there are two basic entries: debit account receivable and credit revenue, credit sales revenue. Sometimes sales revenue is called net sales, sometimes it's called sales, but it all means the same thing, right? So it's very, like when there's a physical, when the customer has paid, you debit cash and credit sales revenue. When it's on account, when it's a credit sale, you debit account receivable and credit sales revenue. So that's what is happening. The company has merely not recorded that transaction at all. So 12,500. Okay. 1 minute. Okay, then we have part B. So the part B is after various efforts to collect 5,500 owed by customer failed, the company decided to write off his account. Okay, so what should be? Yeah. So now I know now we need to assume that like I said, the question will be done with the allowance method. Rather, that's how questions are done. So like it was shown over here. Like we're shown here, when you're writing off, you have to when you're writing off, you debit the allowance for doubtful accounts and you credit account receivables, right? Because now the company is totally writing off what they have, and the company, as like you said, because they have allowance for doubtful accounts over here in the tribal, that means it's a company that follows the allowance method. It doesn't follow the direct write-off method. So over here you have to debit allowance. Yeah.
For doubtful debt.
Yeah, let's call it ADA. Like that's a short form. Okay, ADA. A debit ADA 5,500 and credit accounts
Receivable.
Yeah, 5,500. Also, when you use a short form, you need to generally let the reader know. So when your professor is checking the question, they might understand it, but just for a general standard practice, when you use any short form, you just explain it, right? So allowance for doubtful accounts. Okay, so that is the second one, right? And then we have C. A check amounting to 3,000 was received from another customer whose account has been written off during the financial year 2015. All right, so this is one thing that I did not exactly cover. So now when it comes to writing when it comes to writing off a bad debt expense, right? So there are two entries, right? Firstly, if in the first entry you debit bad debt expense, you credit doubtful accounts, and then when you want to write it off, like completely write it off, as it is a complete loss, then you debit doubtful accounts and you credit accounts receivable. When you are now over here, the opposite has happened. The company has already written off these 3,000 ringgit, so they have already done those entries. Now the customer has actually paid that amount, even though the company thought that okay, they will not get it back from the customer. The customer has come back and said, okay, here, this I owe you this money, I paid you. So now we have to basically reverse. We have to reverse that transaction, right? So what we do first is what we do first is, because over here, the second entry is that you created account receivable and you debited allowance for you created accounts receivable and you debited allowance for doubtful accounts. So we have to reverse it. So here we debit accounts receivable. Okay. We debit account receivable, which is how much was it? 3,000. And you credit ADA, right? This is the first entry. What is the second entry here? Now the company has received 3,000. The amount has been received by the customer. What does that mean? Yeah, debit cash.
3,000.
Yeah, debit cash 3,000 and credit.
Credit account receivable.
Yes, right. Account. This is the standard thing that you do when you receive money. So yeah. So for this for this transaction, there are two entries. First, you have to reverse what the company now. Earlier, the company wrote off. The company had written it off by when they would have written off the 3,000. What they would have done is they would have debited ADA and credited account receivable. Now we are reversing that and we are debiting account receivable and crediting ADA. All right. Okay. All right. That is part C. All right. Now D. D, we have based on previous year's experience, the uncollected amounts are estimated at 5% of account receivable. Okay. So here they're telling us what to add to the ADA. Right. So first we must calculate, okay, how much is, so they're telling us that the allowance for the year is estimated 5% of accounts receivable. So what is the account receivable here is 45,000. So 5% of account receivable is 45,000. No, 5% into 45,000 equals is 2,000 is equals 2,250. So this amount needs to be added to the allowance for doubtful accounts. So when the company is estimating that this amount of money from the account receivables will potentially be not be paid. So what you do is the general, like it was shown here, the entry required is debit bad debt expense and credit allowance for debit bad debt expense and credit allowance for doubtful accounts. Yes. All right. So debit bad debt expense 2,250 and credit ADA 1,250. Is that clear?
Yes.
All right.
Yes.
Okay. And then we have part E, right? So now part E is the note receivable is a 3-month note and was accepted on December 1st, 2016. Both the principal and interest will be received on maturity date. Interest on the note receivable is to be accrued at year end. So now there are multiple things going on in part E. So we cannot simply immediately debit and credit. We have to first find out what needs to be debited, we have to understand what this note receivable is about. So first of all, let's just make a small timeline. So generally, to make things a bit easier, it's easy if you can create a small timeline to make things a little clearer for you. Right? So let me just do that. Okay. Right. So let's say we have now the note was received on December 1st, right? So that is the first month. And then we have, let's say that we have here January 1st. December 1st. And then over here we have Feb 1st. All right. So these are the 3 months. These are the 3 months for the note receivable. So it's a 6% note receivable. All right, owed that the company has received. So one important thing to note here is that the company is giving the money. Basically, the company is giving the note to the customer, and so at the end of these 3 months, the company will receive the principal and the interest on the maturity date. But now what matters to us is we are looking at the 2016 accounting date, right? We're not looking at we're not looking at 2017. So what what matters to us is this interest that is receivable is accrued at year end. So if we look at the interest, just 6% interest, right, for the company, 6% interest for the company into 10,000, because it is shown here it is 10,000. That would be that would be 600 ringgit, right? So that is the interest that is the interest that the company will receive if it is an annual note. However, it is a 3-month note, so we need to apportion it, right, into 3 months. First of all, let's apportion into per month, right? So if we take 1/12 into 600, the interest received per month is 50 ringgit, and for 3 months, it's 150, right? And so at the end of December, on December 31st, so for the 3 months, the interest that the company will receive is 150 ringgit, right? But the amount that is accrued at the end of December, at the end of the first month, is 50 ringgit, because at December 31st, December 31st, the interest accrued is 50. On January 31st, the interest accrued is 50. And finally, on February 28th, there's the full 150 will be owed. So on February 28th, the principal of 10,000 ringgit will be repaid, as well as the interest of 150. But we are concerned with the year 2016. So we need to look at this is an accrued revenue, right? So as we had discussed before in the adjustments class, accrued revenue is an asset. Accrued revenue is basically like account receivable. So here we'll have, for December 2016, interest receivable 50, and then interest, debit interest receivable 50, credit interest revenue 50. Did you guys understand that? How that was done? Was that clear?
Can you repeat again for 50 ringgit?
Okay, so now this note was taken on December 1st, 2016. So first of all, there's one thing that's important. So when it said a 6% short-term note receivable, this 6% always means the annual interest, right? That's very important. So the annual interest of this 10,000 ringgit note is 6%. Okay, so now we're finding, okay, what is the interest for the whole year? What is the interest for the annual interest for this 10,000 ringgit note? It's 600, 6% into 10,000, right? But now we want to get it. Okay, if it's 600 for the whole year, we want to find out how much is the interest each month. And so there are 12 months in the year, right? So 1/12 into 600, and you get 50. So we find out that the interest per month is 50. Okay, and now they have taken the note. I mean, not they have given out the note on December 1st, 2016, right? And we are concerned with the accounting year until December 31st. So we are concerned only with the first year. So for our accounts, right, for the transaction that we are looking at, we are only interested in the interest that is receivable for the month of December, and that is 50 ringgit, because this interest is not paid. The interest and the principal, and the 10,000 amount plus the interest over the 3-month period will be paid by the person who took the note. It will be paid at the end of February. So right now, this interest money that the company should receive, it is an accrued revenue. It's money they will be receiving, but for right now, the customer has not paid that amount yet. So at December 31st, the interest accrued is 50 ringgit, right? And so this is how it is accounted for. You understood how that was calculated?
Yes, because just 1 month, right, for December.
Yeah. And okay, and on February 28th, let's just, it is not needed, but let's just show it. So on February 28th, on February 28th, what would be, can anyone say what would be the, entry?
Is it 100 for income interest?
What?
100 for income interest.
No, I mean the entire thing. So now look,
150.
over the 3-month period, this note will bring in interest of 150 ringgit, right? On February 28th, right, at the end of the 3 months, the customer will pay back the principal amount, which is 10,000. The principal means they already like the actual amount that was given out, right? Plus the interest. So at the end of February, the customer will give 10,000 plus 150 return back to the company, which is 10,150, right? So if you want to account for the transaction on February 28th, we put debit, cash.
Debit cash, credit account receivable.
Yeah, 10,050. Okay, now what do we credit? This is with this. Yeah, what should be credited here? There will be 2 credits. We'll have cash is debited. When there are 2 accounts being credited, it's split between 2 accounts. So first you credit. So here, when it was given out, short-term note receivable was debited, right? So here, short-term note, just short-term NR. Short-term NR, you can put 10,000, right? And interest.
Interest receivable.
Yeah, interest revenue. Here it's interest revenue because they have received it on February 28th. Interest revenue 150. This would be the journal entry on February 28th once the company receives the principal amount of 10,000 plus the revenue, interest revenue. Get is that clear?
Yes.
Okay. All right. So so we have completed the journal entries. Okay. Now we have to update the relevant accounts affected. Okay. All right. First of all, we have to list down what are the accounts that are affected, right? So let's just list down the accounts that are affected. Okay. Okay. So based on this, what are the accounts that are affected? Over here, what are the accounts that are affected? First, we have accounts receivable, right? So we have accounts receivable. Okay, accounts receivable. We have allowance for doubtful accounts, right? We have sales revenue. Okay. We have bad debt expense, interest receivable, and interest revenue. So basically, they're asking us to show, they're asking us to update the relevant accounts. You have to show each of them with a T account, right? So how each of these accounts was affected by the transactions that we have just generalized. We have to show we have to show that very clearly. Okay. All right. I'm sorry. Just give me one moment here. I'll be back. Yeah. Can you see my screen? You can see my screen, right?
Yes.
All right. So these are the accounts that are affected. And now we'll make a we'll make a T account to help deal with them. All right. All right. So first, let's deal with accounts receivable. Right. So the brought forward amount. Okay. The brought forward amount. Okay. Was debited is 45,000. Now we need to go through the journals and we need to add them to the T account, right? So the first journal is account receivable debited 12,500, sales revenue credited 12,500. So we put 12,500 here. Then 1 second. Let's just sales revenue. So account receivable debited 12,500. Sales revenue, and we would add 12,000. We would credit 12,500 to sales revenue under accounts receivable. Okay. All right. Okay, that is for the first journal. Then we have debit ADA, allowance for doubtful accounts, and credit accounts receivable. I'm sorry. Yeah. Over here, the brought forward amount should be 312,800. And then we do the other one, account receivable. How much was it? 12,500. Okay. All right. Then we have allowance for doubtful accounts. Let's create another one. Allowance for doubtful accounts. Allowance for doubtful accounts. All right. So we have the what is the brought forward value for allowance for doubtful accounts? What's the brought forward value for allowance for doubtful accounts? It's 2,600, right? So the brought forward value, I mean, the brought forward value means whatever is in the trial, unadjusted trial balance. So brought forward value is 2,600. So now if we are accounting for the part B transaction, debit ADA 5,500, credit account receivable. All right. So here we put ADA 5,500. It's account receivable is credited and ADA is debited. And yeah, ADA is debited. Account receivable 5,500. All right. Is that clear? Was that clear?
Yes, so far so good.
All right, that is clear, right? Okay, and then we have part C where we debit account receivable 3,000 and credit ADA 3,000. All right. What is that? Yeah, debit account receivable 3,000, ADA, and credit ADA 3,000. Right. And then we have the next journal entry, which is this one, debit cash and credit account receivable. Okay. Just create one for cash. Cash, we don't really have a brought forward value because we don't, I mean, they haven't given us what the cash brought forward value is. And, but let's just show it anyway. So it's debit cash, credit account receivable, right? Debit cash, credit account receivable. So debit cash 3,000 and credit account receivable 3,000 cash. Okay. Okay, then moving on to part B, we have debit bad expense 2,250 and credit ADA. Bad debt expense, right? So what does it say? Credit bad debt expense 2,250, debit bad debt expense 2,250, credit ADA 2,250 ADA, right? And credit you just put bad expense. That's like a short. That's like a short term. So we have added the part D, part D, part D transaction to the account as well. All right. And then finally, we have debit interest receivable, credit interest revenue. So we have to create two new small ones for this one. Okay. So we have interest receivable, interest revenue. Okay. So we debit interest receivable by 50 and we put interest revenue, and we credit interest revenue by 50 and we put interest receivable. Was that clear? Did you guys get all of that?
Yes.
All right. Now we have to balance it off, right? So how much would it be in total? This would be 60,500. 60,500, right? So let's just, yeah. So the balancing amount would be this. So now this would be the brought forward amount in the adjusted or carry forward amount in the adjusted trial balance, right? So let's just highlight that. Okay, this is the amount that now we will have to add here to the adjusted trial balance. And then we have sales revenue. Okay, 325,300. 320. You don't have to show this specifically. You can just add it here because you know it's up there because there's nothing on the credit side, right? So if it's only on the debit side, if it's only shown on the on the credit side, you know that it will be the same thing here, right? 325,300, and this will be carried forward on the sales revenue side. Yeah, and this will be carried forward. No, this will be yeah. Now let's write SOPL here. And this will be the sales revenue will be on the SOPL because right now we are more worried about the statement of financial position. So the accounts receivable is there in the statement of financial position. So I put carried forward. But here the sales revenue is there in the SOPL. So we just add SOPL over here. All right. And then we have allowance for doubtful accounts. This is 7,850. Okay. 7,850. Okay. And then what is carried forward? Yeah, this one minus this 2,000 2,350. This amount is carried forward by allowance for doubtful accounts. Allowance for doubtful accounts is is there in the is shown in the statement of financial position, not in the SOPL, right? That's important to remember. For cash, see, for cash we can't really show much here because we don't know what was brought forward. All right, but regardless, you can just add 3,000 here and say this amount is. No, we just see this empty. I actually the T account on cash, I don't even think it was necessary to be shown because they haven't given us a brought forward amount of cash, right? So let's just leave that as it is. And then we have bad debt expense, all right? So this bad debt expense, once again, 2,250 here as well. And this also, the bad debt expense, it's an expense, right? So it will be shown in the SOPL. All right. And then we have interest receivable. Interest receivable will be, I'm sorry, just one moment here. Yeah. Okay. Sorry for the interruption. Okay, so now we have interest receivable, interest revenue. Both of these will be shown in the SOPL. SOPL balancing amount also is 50 here. Okay. All right. So these are the. Now we've done the second part of part A, which is update the relevant account to show like what is the final value, right? So now we can proceed to the next part of the question, which is prepare the extract of the statement of financial position as at 31st December 2016, showing the asset section only, right? Okay. All right. Okay, let's do that. Where is that? Okay, what's the company? Okay, Murni, SOFP, Murni, Berhad at 31st December 2016. Okay. All right. Then we have assets, right? So now we can the assets that we have that we can show are net sales. And this is not an asset, right? So we have to show the they wanted to show the assets section only. We have the account receivables. We have account receivables, which is how much is the account receivable now? It's 52,000. It's 52,000. Okay, but now we have to show the ADA, and the ADA is deducted from the accounts receivable because this is the amount that the company expects to not be paid back, right? So we have ADA, all right, and this would be minus 2,350, all right, minus 2,350. Okay, All right. And then we have the short term NR. This would be 10,000. Okay, because the interest is not shown on the statement of financial position. That is shown in the SOPL, right? So these are the assets that are remaining for the company at the end of the year, the adjusted statement of financial position. And so the total would be some total assets. Yeah. So yeah, is that clear? Do you guys have any questions with how that was done? Hello, is everything clear?
Yes, brother.
All right. Okay. Okay. All right. So then part A is done, and so is part B. Okay. Okay, so that is part A and that is part B. Part C is explain why direct write-off methods for uncollectible accounts is not acceptable for financial reporting purposes. So I explained this in the beginning. Can any one of you explain it back to me based on what you understood? What if you want, if you have to write like a 1 or 2 line answer to answer part C, what would you write? Can someone give it a try for part C? Can someone give it a try? Anybody? So is anyone able to answer this question? Part C? It'll be a very short thing. Okay, let me just explain. So right over here, as can be seen, the company has used the allowance method when dealing with bad debt expenses. They have not used a direct write-off method. So the problem with using the direct write-off method is when the company estimates that this amount of money will not be paid back by a customer, they immediately debit bad debt expense and they credit accounts receivable, correct? So the problem that happens is the correct values are shown. Now in the company's statement of financial position, the accounts receivable value is not wrong because it was reduced to show how much the company expects to lose, right? Or how much bad debt the company has written off, right? But it does not show. It does not show how much the company has written off. It just shows, okay, what is the account receivable now? It does not show what is the original accounts receivable, and then okay, this amount was removed, and now we have the final accounts receivable. Like for example, over here. Yeah, just 1 minute. This is a slight error actually. Yeah. Right. Yeah. So now, for example, over here, in this statement of financial position, we have the actual account receivables, right? What the customer owes, what is owed to the company, and then we also have the allowance that okay, around 2,350 ringgit will not be paid by the customers, right? And then this is what the company expects to be paid back by the customer. So we have this breakdown in the statement of financial position, and of course, we will have this also there in the income statement because it will be recorded in the bad debt expense category. This is when you use the allowance method. Now, when you use a direct write-off method, none of this will be shown. What will be shown is directly the final, only this value will be shown, 49,650. So in the balance statement, there's nothing, they don't show the actual account receivable, like what actually the company should be paid. They don't show the allowance or the bad debt expense. They just directly show the final amount. So there is like a discrepancy between the income statement and the statement of financial position. So the bad debt expense is shown in the income statement, right? But it is not shown in the financial position. And this goes against the matching principle in accounting, where things should where all transactions should be shown on both statements. Essentially speaking, they should match each other. So that's a bit of a problem, right? And therefore, that is the reason. That's like a little detailed explanation, but that is the reason why the direct write-off method for bad debt expenses or for uncollectible accounts. Uncollectible account is another word, another term used for bad debt expenses, is not acceptable for financial reporting purposes, right? So that is the answer in a nutshell. Did anybody understand? Did you guys understand that? Was that clear? Why the direct write-off method is not used?
Yes, brother.
Okay, so you can say it opposes the matching principle in accounting, where the uncollectible amounts are only shown in the income statement and not the balance sheet. So this is a brief answer, but if you need to explain it a bit, then it can. If you need a little more explanation on what it is exactly, you can. But saying I gave the explanation, or I gave the explanation in detail, right? So that is this question answered on bad debt expenses, right? So let's try doing another question. Okay. Rosemary Berhad. Okay, so let's do this question, and then we'll share. So this question, let's try to move it a bit fast. And I would like you guys, if you can interact more and like answer, like do it along with me. So now the first question was done, right? So now you would have an idea of how the question is answered. So now let's try to interact a bit more, and so that to make sure your understanding is clear, right? So we have the question: Rosemary Berhad is a distributor of New Zealand dairy products in Malaysia. The relevant account balances of Rosemary on December 31st, 2016 are shown. Okay. Trade receivables from retailer 1, which is the first customer, right, is 26,000 ringgit. Trade receivables from retailer 2 is 14,000 ringgit. Allowance for doubtful accounts is 1,000 ringgit. Okay. It is a policy of the company to allow a trade discount of 2% if the value of purchases exceeds 50,000 ringgits, and it is they offer a credit term of 4 out of 30 net 60 to all its customers. Write off trade receivable that is still outstanding after 6 months from the date of sale. All right. Okay, so the following transactions occurred in the year 2016. Received payment from retailer 1 for full settlement of outstanding amount. Sold goods to retailer 3, 8,000 ringgit on credit. Write off retailer 2 account. After discussion with retailer 2, Rosemary agreed to accept 4,000 cash paid immediately as part settlement of the outstanding account. The balance is paid using 5% 9-month note receivable. Okay. July 18th, sold goods to retailer 1, 60,000 ringgit. August 16th, received payment from retailer 1 for full settlement of outstanding amount. October 6th. Okay. All right. So let's go one by one, and let's generalize it first, and then we can answer the question. All right. Okay. So journals. Okay. All right, so on February, so what is required of us? Prepare the ledger accounts of retailer 1, retailer 2, and retailer 3 for the year 2016 to record the above transactions. Okay. Let's first create a journal for each transaction, and then we can move on to create the ledger accounts for each retailer, right? So on February 19th, all right. On February 19th, we had received payment from retailer 1 for full settlement of outstanding amount. So what is the outstanding amount of retailer 1? Based on the question, what is the outstanding for retailer 1? 26,000. So we have received full payment. So what do we debit? You debit receive payment of 26,000 cash,
Debit
26,000,
Cash.
and you credit
Receivable.
trade receivable 26. All right. So this is the first transaction, and then we have April 5th. April 5th, sold goods retailer 3, 8,000 ringgit on credit. So here, what do we debit? Debit.
Account receivable.
Yeah, trade receivable.
Receivable.
8,000.
8,000.
All right, and credit
Cash.
sales revenue. When you make a sale on credit, yeah, sales revenue. Okay, and then we have May 15th. May 15th, you have write off retailer 2 account. So when you write off the retailer 2 account, what you do is like, yeah, you debit ADA and you credit trade receivable, correct?
Trade receivable.
Trade receivable. How much is this amount? How much should be here? This debited here for May 15th, write off retailer 2 account. How much should be debited?
Is it 1,000? No.
No, it's 14,000. Right? They have written off the entire retailer 2 account. Retailer 2 account is 14,000. 14,000. Okay. And then June 1, you have, after discussion with retailer 2, Rosemary agreed to accept 4,000 cash paid immediately as part settlement of the outstanding account. The balance is paid using a 5% 9-month note receivable. Okay, so this is a this is interesting. Okay, so first of all, let's deal with the cash, right? So so first of all, we had initially written off their trade account. So now we have to undo that. So basically what we have to do here is you debit trade receivable and you credit ADA. That's the first step. Okay. Okay. So 14,000. All right. So you have to reverse it, and then you debit cash 4,000. Yeah, okay. You debit cash you debit cash 4,000. You debit note receivable 10,000 because the total amount is right, and you credit trade receivable 14,000. Was that clear? Was that clear? Hello.
We're still thinking why debit not receivable.
I'm sorry, what? Yeah, okay. So now, now, first of all, this is the this is what they have received. So now this is the payment. So initially on May 15th, the 14,000 was written off, which we dealt with over here. Okay. Now over here, they after discussion, they have decided to pay. The customer has agreed to pay, right? And so like we did last time, like over here, I think last time we did it over here for this one here. The company had paid back 3,000 after it had been written off. So you debited account receivable, credited ADA 3,000, and then this for the second entry you debited cash and credited account receivable. So for this question, the first part is the same. We debited trade receivable, which is a trade receivable and account receivable. You can use the terms interchangeably. So debit account receivable, trade receivable, credit ADA. This was the same. Now the question is, but over here, the second entry is where how they decide how the company received that payment. So 4,000 of it was received via cash, and 10,000 of it was received via the note receivable, right? So now now we debit note receivable, but once the money is actually received at the end of this 9th-month period, we will debit cash and credit note receivable. Just like over here, at the end of the 3-month period, you debit cash and credit the note term receivable. But of course, now what we need to deal with over here is the is this interest, right? And so is this interest. So we can deal with it. We deal with that interest. So it's a 10,000 note receivable amount. It's a 9-month note, and it is at 5% interest annually. So first of all, let's take the annual interest. Let's start. Okay, note receivable. Okay, and then we have annual interest equals 5% into 10,000, which equals 500, correct? Equals 500, right? However, the 500, and then the monthly interest equals, you simply divide 500 by 12. So 500 divided by 12 equals let's leave it as because it is a fraction. Let's leave the monthly interest as that amount. Okay. Now the now this month, this 9-month note receivable was given out on June 1st, right? So that means if you look in the year 2016, there are 7 months remaining: June, July, August, September, October, November, and December. So it will be paid at the end of 9 months. So it will be paid on January and February. But on December 31st, there will be accrued interest. There will be accrued interest, like we had in the last question. There will be accrued interest for 7 months, correct? So for that 7 months, we basically take 500 into 7 over 12. So accrued interest equals, you can either take 500 into 7 over 12, or you can take this value into 7. Either one works. So 500 into 7 over 12 which is 292, or rounding up slightly. So this is the accrued interest receivable. Okay. Okay. So like we did for last question, we can show this on December 31st. So let's leave this for now. And when we come to December 31st, we'll show that, right? Okay, so then July 18th, sold goods to a retailer one, 60,000 ringgit on credit. Okay, so let's go, just go July 18. Okay, and then we have, what do we debit here? Debit what?
The cash.
No, on credit.
Onto the
Yeah, trade receivable. Okay, and you credit
sales revenue.
sales revenue. All right, that's good. Okay, now it says here sold 60,000 on credit, but also if you remember in the question, it says here it is a policy of the company to allow a trade discount of 2% if the value of purchases exceeds 50,000. Correct? So over here, what would that be? So you can just put equals. You can put 98%, because they are allowing a discount of 2%, right? So that means you will charge them 98% of the total amount, right? So 98% into 60,000, which is 58,800. Wait. Yeah, okay. 98,000, 58,800. And then we moved on to August 16th. Receive payment from retailer one for full settlement of outstanding amount. So if you look at here, retailer one have purchased sorry, just one moment. Okay, so here we debit. So when you receive payment, how much what should be debited? What should be debited over here?
Cash.
Cash, right? Okay. Debit cash and credit trade receivable. Okay. And then on October 6th, we have write off retailer 3 account. October 6th. Write off retailer 3 account. So retailer 3 account was this purchase on April 5th of 8,000 ringgit. So now the company wants to write it off. So basically it'll be the same thing that we did over here for retailer 2. So we debit, what do we debit here? When you're writing off, we debit what? What do we debit?
Debit ADA.
Okay, debit ADA, 8,000.
Credit trade receivable.
Yeah, debit trade receivable, 8,000. All right. And then on November 5th, sold goods. Retailer 1, 55,000 on credit. Then it is the same. Same thing that we did over here. Basically do it here. So this would be once again 55,000 55,000. No, sorry. This would be 55,000 into, because it is greater than 50,000, right? 53,900. And then December 31st, it is estimated that 2.5% of trade receivables will be uncollectible. Okay, so okay, let's leave this. Let's leave this for now, and let's prepare the retailer 1, retailer 2, and retailer 3. What do you say? Retailer 3 ledger accounts separately, and then we'll do the general one later on, right? So let's say, okay, we have the retailer 1. Okay, so now we will let's create the ledger for each of the 3 retailers. Let's just create one more for ADA. Allowance for doubtful accounts. Okay, all right. So now we will just quickly yeah. Sorry. Okay. Okay. So then we have the retailer 1 ledger. So the first one. Okay. Yeah, I was just getting a bit confused with the ledger for retailer 1 exactly. Okay. All right. So the first one, like put over here, we have debited cash. So we have received. We have received. we have received cash from retailer 1. Okay. So I'm getting close. let's put 26,000. We credit trade receivables, right? So we need to look at it from the perspective of retailer one. So the first transaction is they have paid us off. They have paid us off the trade receivable, right? And then on April 5th, we sold goods to retailer 3, 8,000 ringgit on 8,000 ringgit on credit to retailer 3. So here, because they owe us the money, so we will debit we will debit that 8,000 amount on their ledger. All right, so this is what they owe us now. Okay. Brought forward 26,000. Yeah, we have to also write what was brought forward. So here we have brought forward 14,000. And over here we have brought forward. Here we have for retailer 3 we have no brought forward, of course, right? And then so we have accounted for this one. So on May 15th we have write off retailer 2 account. So when writing it off, as shown here, we debit ADA and we credit trade receivable. So when it's debited for us, essentially we want to credit for them. So we put 14,000 here, ADA. So in our mind, they no longer owe us anything because we have written it off. And then on June 1st is when we had this entry where they agreed to pay us back, right? So now when they agreed to pay us back, we have to again add back the add back the trade the trade receivables. We add this amount back, right? And now we have to deal with how they decided to pay us. So they paid us 4,000 in cash. Okay, so we put 4,000 in cash, and they paid us 10,000 in with a note receivable. 10,000. Okay, so yeah, 10,000 with the note receivable. And something that we have to remember as well is that the accrued 7-month interest, we did not add it here, right? We can add it here now. So we can put debit interest receivable 292, credit interest revenue 292. Okay, we can add that over here to the amount that they owe us, that they owe us at the end of the year. So the amount that they owe us would be 292 at the end of the year, and they put interest receivable. Okay, so that this is from the retailer 2 account. That is we have dealt with everything up to here, right? And then we have on July 18th sold goods to retailer 1, 60,000 ringgit on credit. Okay, so sold goods to retailer 1, so TR 60,000 on credit has been sold. And then on August 16th, they have paid us back that full amount. So we have 60,000 that's been paid back to us on cash. Okay, so basically what you would realize is that if we for example this sorry, not 60,000, it's 58,800. Yeah, so for this transaction, the 58,000 transaction, when we have debited trade receivable for us, like we have debited it for us, like in their account also we debited, right? You understand? And when they pay us, so because this is the amount that on the left side basically is the amount that they owe us essentially, and here is when they make the payments, right? So yeah, this is actually incorrect. Wait, this sorry, this should yeah, this should go here. But this is the amount that they owe us at the end of the day. It's an accrued revenue, essentially speaking. Okay, so then we have dealt with this amount, and then on October 6th, write off retailer 3 account. Write off retailer 3 account. Okay, how did we write off retailer 2 account before? We simply credit the ADA. Sorry, we debit ADA and we credit the trade receivable. So now this is shown. Okay, we have written it off. And then on November 5th, we sold goods to retailer 1, 55,000 ringgit on credit. Once again, TR 55,000. The amount that they owe us is 53,900 because of the 2% discount, right? And okay. And then, okay, we estimate that 2.5% of trade receivables will be uncollectible. So first, yeah, 2.5% of trade receivables will be uncollectible. So what we regard as uncollectible amount of 2.5%. So let's put 2.5% into, this is the remaining trade receivable for retailer 1. So we put that as the ADA, because this is what the company regards as uncollectible, and then we balance it off. Let's just balance this off. This would be 138,700. 138,700. All right, and this would be this amount minus carried forward. Was that clear as to how the retailer 1 ledger was done? Was that clear?
Okay.
All right. So that's how the retailer 1 credit was done. Okay. And then over here, once again, we need to do the 2.5% ADA thing. So let's just put equals. I mean, retailer 2 has not bought anything newly, right? So I mean, for this one, they have already agreed to pay based on cash and a note receivable. So this would not come on a trade receivable again. So we don't have to add in another allowance over here. Okay. To the sum here, 28,292. 28,292 equals this amount minus 292. So carry forward. So the only amount that they owe the company is the 292. I mean, they owe the note receivable as well, but that will be but that is not that will be shown when the time comes. Right now, at the on December 31st, the accrued expense that they have to the company is the interest over the 7-month period. Okay, and then we have ADA, and then we have trade receivable over here. Yeah, I mean, over here the account just is simply closed, as in they purchased cash for they purchased products for 8,000 ringgit, and then that was written off. So then there's nothing really to carry forward because it has already been written off. Okay. Okay. Now we have. So then that would be the answer for part A, which is the ledger accounts for retailer 1, retailer 2, and retailer 3. Okay. Then they say prepare the ledger account for allowance of doubtful accounts for the year 2016 and calculate bad debt expense for the year. Okay. All right. So over here it says here allowance for doubtful accounts. It was the brought forward amount was 1,000 ringgit. So when you're when you're debiting, when you're making allowance, you debit bad debt expense and you credit allowance for doubtful accounts, right? Yeah. So here put 1,000. All right. And you put bad debt expense. Okay, that is 1,000 out there. And then over here, what did we do here that required ADA? So here we debited ADA 14,000. 14,000. Sorry, this is brought forward. Okay, we debited 14,000 for TR, trade receivables. Or here when we wrote off the accounts for retailer 2, we debited ADA. Okay, and then but then again they decided to pay the amount, right? So then we basically we reverse the account. So TR are there. Okay, that was where we found ADA. And the next time we saw ADA was over here when we wrote off the account for retailer 3, and that was for 8,000 ringgit. Uh, 8,000. I'm sorry. Uh, this amount should come here. Brought forward amount, right? So we have that, right? And then we also have this over here which is this ADA was also added. So we have 1,347.5. Yeah, so we can add retailer 1 basically. So this is the debit side for the ADA account, okay? And then this will be the credit side. So if we sum this up, it will be 24,347.5. All right. And then the bad debt expense for the year sorry. So the bad debt expense for the year would essentially be this this amount. Was that clear? 10,347.5.
There, why 1,000 not in the right side for brought down forward? 1,000.
Just one moment. Oh yeah. Actually, that should be on the other side. 1,000. So in the bad debt, the bad debt expense for the year would be 8,347.5. Okay. Any other questions? Was this clear how this was solved? To be honest with you, maybe we did not need to do these journals. We could have directly gone on to the retailer ledger and solved it one by one like this. That also could have been done. But yeah, I decided to do the journals first and then transfer it to the ledger. All right. Any other questions?
For 31 December, just 292 get from the retailer to only, not for, don't compute with the retailer one.
The retailer one, the yes, the ADA, right? Yeah, that should be. Yeah, I solved that down. Didn't solve it here. So here, 31st December, you'd have the interest receivable, the accrued interest receivable, and we also have the allowance to ADA, the 2.5% trade receivables will be uncollectible. So what we do here is to create the allowance as we showed here. To create the allowance, you debit bad debt expense and you credit ADA. So here you debit bad debt expense and you credit ADA. And this value, of course, would be 2.5% into 1,347.5. Yeah, that was I had missed that. Is that what you mentioned?
Yes.
All right. Okay. So any other questions that you guys have? Like, was this clear how to solve? I mean, it's a step-by-step procedure. You have to go through each transaction, create the transaction, and then Yeah, and then do it that way. Okay, is that clear? Any other question before we wrap up the class?
It's quite difficult.
Yeah, it is definitely not easy. See, I think what I'm going to do is I want to do next week's class also on the same topic, because even when I was studying, it was something that I found very difficult. And if you guys like, there are two documents. In this now in on topic I have shared two documents of questions. One is the first document in which I did question 2 and 3, and then there's another document where there is 1, 2, 3, 4 questions. If you guys can try these questions, at least some of them, I think I want to do the next class as well, covering bad debt, because it is one of the most difficult. For me, especially personally, it was probably the most trickiest when I was doing financial accounting. Like, even what we have covered so far in terms of adjustments, inventories, and all that stuff, it's easier. This one is very confusing. So I'm thinking that next week as well, we do the tutorial where we cover these questions and we answer them, just to make it clearer. Because definitely, I think in terms of your final exam, which is coming up in February 3rd, if I'm not wrong. Am I correct? Your exam is on February 3rd, right?
February
Because
19,
you can
if I'm not mistaken.
really, I was see, when I was looking at a minute, let me. Your course code is ACC 1212 1211, right? Correct? It's ACC 1211, right?
Yes, 12 February. Yes,
It's
12 February.
Isn't it 3rd February? It shows the ACC 1211 here. You sure it's the 12th February?
Yes, 12 February. I have checked last week.
I don't know, because see, in this financial, they release a general for the whole university, they release the final examination table. So when I just looked at ACC 1211, I saw it here. Anyways, that's no problem. So the point is, this topic will definitely be tested in your exam, the bad debt expense. So I think we have another tutorial covering these questions. That would make it easier for you and help you clarify a bit, right? You guys agree? You think one more tutorial on bad debt would be a good idea?
Brother, can you cover for the topic dishonored notes receivable for next week tutorial?
Note receivable meaning?
Dishonored notes receivable.
Which one?
Same in the receivable also, but the subtopic is recording for dishonored note receivable.
On it, note receivable?
Dishonored note receivable.
Oh, dishonored note receivable. Oh, okay. Let me try to find a question. So dishonored note receivable is basically that they decide not to pay, right? They have you've given them a note receivable. So essentially, for example, in this question over here, if you look at this question over here, they have decided. If you look at this question, like, they have given a note receivable, and that in 3 months they will pay. So dishonored note receivable is that in the end of the 3 months, they decide not to pay. So that would be covered like any other bad debt expense, wouldn't it? As in terms of the amount. Let's see. Let me try to find a question that is there. I could not see a note dishonored note receivable question. If your lecturer has shared a question that includes dishonored note receivable, please share it, and then maybe we can go through it. But as of now, I don't have a question that covers dishonored note receivable. All right. Let me try to find one, inshallah. Okay.
Okay, inshallah.
All right. So next class, inshallah, we'll be covering. We'll do tutorial questions on bad debts again on the account receivable chapter. we'll do one more tutorial, inshallah, and let's hopefully, inshallah, it'll be clearer to you guys. Okay. It's 1011. Okay, I don't know. It's not showing. Anyway, that's besides the point. If you could just check again to be certain and tell me when your examination date, so then we can plan a bit better in terms of the tutorials. All right. Any other questions before we wrap up the class?
No, brother.
No, I guess.
All right. Okay, then that's it then for today. Jazakallah khairan for attending. Subhanakallah wa hamdika, ashhadu an la ilaha illa anta, astaghfiruka wa atubu ilayk. Assalamu alaikum.
Thank
Salam.
you.
Thank you, brother.
Thank you, brother.
Thank you, brother.